issue that we have picked up is on the global banking crisis, and whether we are still in the midst of the crisis, whether we are out of the crisis, or it's the beginning of the crisis. That's something which we're still debating. Uh, Sajid has been very closely tracking it, and he's also been looking at how this will, if at all, the kind of channels this crisis takes to affect India, if at all. From what we gather from the government as well as policy experts in India, it seems that our banks are well capitalized and are able to weather this storm. Uh, Welcome, Sajid, to this another session of Explained Life, and welcome to all the audience, all those who have taken time out this Thursday to be with us. Sajid, if I may just kind of lay the ground for what the kind of discussion that will follow going ahead. Uh, Sajid, we have seen that we have just been emerging out of the COVID pandemic, and then the war, and then this global financial crisis, global banking crisis to start with, and already the world. But the US, for instance, is growing at a very good pace. The global growth rate is expected to be 3%. The job market is doing extremely well in the US. But then on the other side, you have this banking crisis, prompting uncertainty, or at least there is a fear. There's uncertainty in the markets. So in this context, I think we discuss this where India also, we are seeing a monetary tightening. Although inflation is coming down, still there are expectations that the rate cycle has still not come to a pause. There might be another rate hike in the forthcoming monetary policy. Sajid, if you would want to kick off the discussion with uh, what exactly are the key indicators that you are seeing? What is data telling you in terms of the global banking crisis, the global economy, and then let's take it forward.
Thank you. Very great to be here as always. I think this is a good time to take stock because we're not even finished the first quarter as yet, and think of what we've gone through this year. We began the year with people saying this is going to be a soft landing. Markets were fervently hoping that this would be a soft landing. It took about 2 data points from the US, 2 strong labor market data points, and then a perception change. This is going to be a hard landing, that the US may have to take rates to 6%. Within a week, 2 mid-sized US banks go down, worries about a full-blown banking crisis, financial crisis, and then concerns about a near-term recession. So we've spanned the spectrum of outcomes in just the last 10 weeks. We're not even into the second quarter of 23. Ready to make sense of all this, I'm going to share my screen actually and just ask the question, is this time different from 2008? Because the elephant in the room question really is whether this is like 2008. Some of the resemblances to 2007-8 are quite eerie. You look at US, you see housing prices have been falling sequentially at least. Some mid-sized banks, as you alluded to, have gone under. There's risk aversion taking hold. I'll talk about how credit conditions have begun to tighten. Bank stock prices are falling, which is never a good sign. And initial signs that there was some contagion across the Atlantic, where we had Credit Suisse and then concerns about another large European bank last week. So if you had come from Mars and looked at all of this, you'd say, well, this is eerily resemblant of what happened in 2008. But the point I'm going to make today is that there are very important differences between what's happening today and what's happening in 2008. And it's important to appreciate that. Let me start by saying, I'm going to give you my conclusions to start with and then talk about and then disentangle them further. What we're seeing, at least for now, and the big caveat is there's so much uncertainty that we can't have definitive views. But for now, what we're seeing is, at least in the US, what's a liquidity problem for mid-sized banks, not a solvency problem of the kind we saw in 2007-8, where in fact, housing prices had collapsed and the loan books of many banks had become impaired. That is not the situation now. The second difference is normally when you see financial sector stress, it's actually a symptom of an underlying problem in the economy. Either excessive leverage, in the case of 2007-8, it was household leverage in the US, or prices are falling in a sector, growth is slowing, corporates are under some pressure. But what's very different this time around is that the financial sector stress is juxtaposed with actually a very resilient global economy. And I'm going to talk about that some more. But the starting point to how we got here was just the massive stimulus that we saw in advanced economies in the US after COVID. Now, we're already used to, several rounds of QE after 2008, but you can just see from this chart the sheer order of magnitude that policymakers threw the kitchen sink at the economy after COVID, fiscal policy, and large monetary policy. Now, while everybody was worried about inflation and lack thereof, what was missed by most commentators at the time was that this led to a huge surge in bank deposits, because when the Fed, for example, is creating money, right, that eventually will show up in households parking this in higher deposits. Remember, at the time, the recovery was slow in the first year because restrictions were in place. We had multiple bouts of COVID. So what did banks do? They essentially took these zero interest rate deposits and they bought government bonds, right? And ostensibly, that's the sensible thing to do. These are risk-free securities. That's what regulators think you should do, right? But in many cases, as we'll see, these were imprudent decisions because they bought long-ended bonds and therefore exposed themselves to more interest rate risk. Then comes the fact that we have very high inflation, and this is not a discussion about COVID, so I'm going to just summarize that the very elevated inflation that we've seen around the world. This is the highest inflation the world has seen since the 1970s, was a function both of very elevated demand because of the sheer quantum of fiscal and monetary stimulus, but it was the interaction of that demand with the supply side that was struggling. Supply chains in COVID, were shut down repeatedly in subsequent waves. We then had the war, the Russia-Ukraine war, and that led to supply shocks in commodities and food prices. And I guess the least appreciated supply shock is the labor market, which I'll talk about in a second, that many people in advanced economies dropped out of the labor market. So you get a perfect storm where demand is very strong, the supply curve is moved back, and you get very sticky inflation. Now, central banks in advanced economies were a little bit late to the party. Much of this war in 2021 was characterized as being transitory inflation. By 2022, it was clear that this was not transitory. And so you see the most aggressive rate hiking cycle. If you look at the left-hand side chart, in 40 years, the last time, especially DM rates, developed market rates went up so aggressively was the 1980s, right? And you can look at the right-hand side chart, how US bond yields reacted. So this is the number of months after a rate hiking cycle starts. And this was a very sharp increase in bond yields compared to previous occasions of tightening, 1994, 1999. So when you have 400, 500 basis points of rate hikes, policy rate hikes in a year, we've been worried for a while that the speed of this tightening meant something would eventually break. We didn't know where it was going to break. There were some pressure points in the UK pension market last September. There were pressure points in crypto space in December and January. And then you had the mid-sized banks. Now, what happened was, because you had such sharp increases in interest rates, bond prices, which are inversely correlated to interest rates, fell. So you've got banks who bought all these bonds at zero interest rates, for example. Rates go up 250 basis points or 300 basis points, and the value of these bonds fall. And that was the problem that Silicon Valley Bank had, that I'm going to avoid too many technicalities, but banks essentially hold these bonds in two buckets. There is a available for sale where you have to market these bonds every quarter, and you take the capital hit that very quarter. So there's no problem there because that's quite transparent. The problem was in this other bucket called held to maturity, where banks don't intend to sell these bonds, and therefore they don't have to market their losses, right? But there were large unrealized bond losses, right? And the FDIC tells us in the US it's over $600 billion. Now, in the case of Silicon Valley Bank, it was in a universe by itself. So if you look at this chart, this is the amount of equity, tier one equity that banks have at the blue bar, and then the orange bar tells you what happens once you adjust this for unrealized losses. Now, many banks can weather the shock. They have enough equity so that even if you had to sell those bonds in a fire sale, you can absorb it through equity. In the case of Silicon Valley Bank, their equity was completely wiped out. And that was the problem, that when depositors realized that there wasn't enough equity, they began to flee. And this became a self-fulfilling deposit crisis, because when depositors fled, then Silicon Valley Bank was forced to sell that bond at a huge discount and incur that loss. Right? Now, one other point is Silicon Valley Bank was particularly exposed because it had a very small fraction of sticky retail deposits. Right, so this was imprudent risk decision making on both the asset side and the liability side. On the asset side, you're buying long dated bonds and exposing yourself to duration risk. On the liability side, you've got very small fraction of sticky retail deposits. These were high value wholesale deposits with a very homogeneous venture capital community, all of whom left together. So that was the problem. But the difference, the reason I'm going into so much detail is this is essentially this is essentially a liquidity shock, right? This is think of the 1930s, a self-fulfilling bank run, where if enough depositors want to leave, then banks are forced to sell bonds that they otherwise wouldn't. And because you're forced to sell bonds and accept these large losses, you eat into your equity, and these self-fulfilling fears are realized and the bank goes under. But it's very important to distinguish this kind of shock from a shock where banks' loan books are really impaired and they have a true solvency problem. Because if you have a liquidity problem such as this, central banks have the tools to prevent it, right? Central banks are the lender of last resort. And therefore, you saw the Fed jump in and say all deposits will be protected. And the minute depositors realize that deposits are protected, then the incentive to run is much less. So I know in many banks, uninsured deposits have gone up, right? But when the Fed comes in and says ex post facto that no depositor will lose money, then the self-fulfilling run chances come down. So this is a very different situation from the 2008, where you actually had huge losses on your loan portfolio, and there were real question marks on solvency. So that's one big difference, that regulators have the regulatory tools, the lender of last resort tools, to prevent this contagion, through forbearance after the fact. But the second difference, which you alluded to, Reddy, is just the strength of the global economy. I joke that this is the most anticipated global recession in the history of mankind. Every 6 months, analysts are saying the recession is coming 6 months later. In June, we said September. In September, we said December. In December, we said March. And look at the first quarter of this year. Global growth is tracking 3.5%. That's a full percentage point above trend growth. So not only is there no recession, but global growth is actually accelerating. Some of this is China, but even if you take out the China reopening, the rest of the global economy has accelerated into this quarter compared to last quarter. So something clearly is going on where you've got some financial stress, but a very resilient global economy, very different from what we saw in 2007, 2008. Just a minute, because everyone I know tracks this, but just look at the strength of US data. If you look at the payroll numbers, the first row on the right-hand side chart, normally you would think by this time payrolls are down to 100,000, less than 100,000. You had 500,000 jobs created in January. On the back of that, you saw 300,000 jobs in February. The work week has barely moved, right? Jobless claims are very depressed, suggesting the labor market's very tight. You had some weakness in auto sales late last year. Auto sales have bounced back this year. The PMI in March that came out last week accelerated sharply to 53.3. The unemployment rate is below 4%. There's no sign of any slowing here in the US economy. And so if you look at consumption this quarter, it's surging at 4.5%. Now,
consumption will not stay at these elevated levels. But the fact that it's growing at 4.5% tells you a little bit about the resilience of private sector balance sheets. Now, why is the private sector so strong? Because the flip side of those large fiscal deficits is that there are a lot of excess savings, a lot of cash that households still have. Governments wrote checks and gave it to households. There was a lockdown for a long period of time. Households could not spend that money. It's still lying in bank accounts. So if you look at this chart, for example, these are US checkable deposits in cash, right? That's lying over there. And look at the surge in deposits in cash that households actually have. So households have a lot of buffers. This is the opposite problem of 2008, where they were highly leveraged. Now you've got excess savings. Household debt, the top right-hand side chart, is much lower than 2008, right? Vacancy rates are much, much lower. So I just want to underscore this point that the private sector is still very strong. Balance sheets are strong, as are corporate balance sheets. That corporate balance sheets also in developed markets in the US, profit margins have expanded. Yes, there will be some slowing for sure. So that is the puzzle, the dichotomy, that you've got some nervousness in financial markets, but the real economy is actually very strong. And credit conditions will tighten for sure. But if you look at any measure of financial stress at the moment, we're not seeing that stress has picked up in any measure. This is nothing compared to 2008, for example. Last couple of things, central banks then have this dichotomy. On the one hand, they need to bring inflation down. The economy is not slowing by itself. On the other hand, they have to ensure that contagion doesn't spread and you don't have financial instability. And in a way, they're going to follow the Tinbergen principle. This is Jan Tinbergen, the famous Dutch economist, who said, you must have as many instruments as you have objectives. And central banks will have two objectives going forward. On the one hand, containing inflation. On the other hand, managing financial stability. They have two instruments. Interest rates will be increased to contain inflation, and you will use a whole bunch of regulatory tools, liquidity, lender of last resort, forbearance, to contain financial stability. And that's what we've seen in the last month, that the Fed has hiked rates, the ECB has hiked rates, the Bank of England has hiked rates, but even as they're hiking rates, they're providing all this regulatory support to make sure that, that the financial contagion doesn't spread. Now, we'll talk about this, I'm sure, later. As Vaidhi said, this will give rise to moral hazard, but there are a lot of concerns we have. My last 2-3 charts here to wrap up. This could raise the question that, well, if this is contained and the economy is doing well, why can't we entertain the prospect of a soft landing? Now commodity prices are down, food prices are down globally. And my short point is because the labor market is very tight. And part of it has been that the supply side in the labor market has been hurt badly in the pandemic. Look at the number of workers in the US labor force over 54. Many people have dropped out of the labor market. So in the US, you've got a secular aging of the population. Older workers have dropped out. Immigration has been tightened such that foreign workers can't use these jobs. So the supply side in the labor market has been hit, and therefore wages are strong. And you can't have wages running at 4.5% and inflation at 2%. So the reason why I think a soft landing is unlikely is because the supply side is not responding. The Fed will have to create unemployment, unfortunately, right, and push wages down to meet that inflation target. So the good news here is that the economy is strong. Central banks have been preemptive, but it's hard to see a soft landing. I'm going to end with this. Well, a couple of things, but a key point is thinking of the framework going forward. So, because of the strength of the real economy, it's unlikely that we see a recession in the next 3 to 6 months, given what I just told you. So, the first outcome that there's a recession, by July, August, JP Morgan only attributes a 20% probability to that. The baseline case is that there's no recession for the next 6 months. Now, in that baseline case, there are still 3 outcomes. There's a 20% chance that you have this Goldilocks soft landing, and I would argue that that is pretty that is an unlikely occurrence. So we're left with these 2 options in the middle. The one option is that the risk aversion that you're seeing in financial markets means credit conditions tighten, and it does some of the work for the Fed. Credit growth will slow, banks will become risk averse, the Fed will finally get some traction in monetary transmission. Rates won't have to go up to 6%. The economy will slow. We'll still have a mild recession later this year, and inflation will come down. There's a second possibility that credit conditions don't tighten enough. The real economy is very strong. The economy doesn't slow enough this year. Inflation doesn't come off. And the Fed, unfortunately, has to keep going and keep going and keep going. Rates go up towards 6%. And then you worry about a hard landing next year. Right? So I think both of these outcomes are still very much on the table, that you get some kind of mild recession later this year because the credit conditions tighten and do the work for the Fed. Or the other option is the Fed has to keep moving and you get a harder landing next year. I'll summarize by saying that the good news is we probably stave off a near-term crisis or recession, but let's not be complacent. Uncertainty is very high. As I mentioned, when US rates go up 500 basis points, chances are more things are going to break. And therefore, EMs will have to be very vigilant. The sobering prospect is, given the labor market, some kind of recession is going to be necessary to bring inflation down. And the original sin here is what we've discussed, that the pandemic support was excessive. The monetary normalization was very delayed. Because it started so late, it had to be very disruptive. And you had to raise rates by 500 basis points. And that created all kinds of pressures. There was regulatory easing of these mid-sized banks. The Dodd-Frank Act was eased. So the annual stress tests were not done on banks like Silicon Valley Bank. And the fact that immigration was tightened meant that the labor market tightness was accentuated. So there's a lot of blame to go around, but these seem to be the original sin. Very last point, what does this mean for India? We'll discuss this in time to come, but just to lay out the channels of transmission, there's a direct, one channel is, and thankfully this doesn't apply to India, but if there were institutions in India that had direct exposure to stressed assets around the world, that would be one channel. Another channel will be if there's global risk aversion, capital flows to all emerging markets will tighten. That's a second channel that we need to be mindful of. A third channel is that Indian bond yields very often reflect what's happening to developed market bond yields. Those have come down by 50 basis points. To the extent that those risk-free rates around the world move, it'll affect India's risk-free rates, and domestic financial conditions will therefore be impacted by what happens globally. The fact that global growth is holding up now, but will slow, and we'll have to have some kind of recession, will have an impact on exports, both goods, and we'll talk about goods versus services. There's a commodity price channel. If there's a demand shock around the world and growth slows, it is reflected in lower commodity prices, which in a way benefits India. And then there's a lot of uncertainty. So there are multiple channels that we'll have to track, and several natural hedges that we can talk about. But Vaidya, I'm going to stop there just to lay the groundwork, and we're happy to dive into Q&A.
Thank you, Sajjid. Thank you so much. I was just wondering what are the questions that I asked now. You have comprehensively covered this, the crisis and the channels that it could probably impact India with. But let me very quickly kind of dramatize the situation because of what has happened in the US. March 8th, Silvergate collapses. March 10th, you have the Silicon Valley Bank bailout or complete collapse. And then within 2 days, March 12th, you have the other bank, Signature Bank. So it is just like, every alternate day you have seen a bank collapse. And even as the US was recovering from this, within a week you see that Credit Suisse there is trouble in Credit Suisse. The Swiss regulation, the Swiss central bank opens up a line for it, $52 billion, $54 billion, but still within 2 days they are forced to kind of facilitate a takeover by UBS. So in a matter of just 6 plus 7, 13 days to a fortnight, less than a fortnight, you have seen this a transatlantic phenomena from the US to EU. And I get your point. That has not taken away either the Fed Reserve or the ECB from hiking rates. So they have kind of at one instance, ensured that inflation seems to be a battle that they are fighting and will continue to fight, giving that signal by hiking rates. And simultaneously, US has come ahead and given this huge liquidity support, having said at some time back that SVB or Silicon Valley Bank is not a too big to fail bank, but then reversing its stance completely, right? The way it intervened. So nobody is able to make out, at least I'm not able to make out, whether we are at the tail of the banking crisis, whether we are at the middle of the banking crisis, or it's the start of the banking crisis. So one thing which you said that, on SVB at least, that, on long dated their investments in, their long dated government bonds, etc., which was completely probably imprudent, because of the benefit of hindsight. That was something which came out, or, we could comprehend that a little later. So what are the other risks to banks, the financial sector in the US to begin with, where rates continue to go high, continue to be hiked by the Fed, and may probably, I don't know whether they will touch 6% or not, but in the eventuality that, inflation doesn't kind of, cool off, and job market continues to be as hot as it is today, and US continues to hike rates, what are the other ways in which distress could be seen in US banks and we find more risk there?
It's a great question, Vedi. It's one of the great known unknowns. What I will say is there are some things we do know and we should track, which is that if you look at commercial real estate, for example, it's come under a lot of pressure post-COVID, right? Think of all these half-empty office buildings because people are working from home, and the viability of commercial real estate around the world is under question. Now, these mid-sized banks, these community banks, actually are pretty heavily invested in commercial real estate. So there are two channels here that one has to distinguish. One is just a crisis in confidence. And the crisis in confidence is when people just seize up. And we saw that happen now. But that is also when central banks can bring out their armory of tools and say, we're going to inject more liquidity, we're going to provide more forbearance. Of course, this creates all kinds of moral hazard going forward. But at least you can wrap your hands about that. The bigger worry is that are we going to see some impairment on the lending side, on the asset side, that we don't fully appreciate because rates have gone up to 5.5% to your point, and it's been masked by the strength of the macro economy, that there are some sectors that are really bleeding, that commercial real estate, we're going to have a much bigger problem there. Yeah. And when that problem builds, it's going to take down several banks. And once it takes down several banks, then the linkages will become apparent. So that's one area that I'd be worried about. But there's another area which is an even bigger black box, which is non-bank financial companies. At least banks we know better regulated, capitalized. Now you'll have US regulators, European regulators breathing down every bank, and that should result in a risk aversion. But the question is, what is happening in the shadow banking space? Right? Do we even know how much leverage there is? Do we know what those linkages are? Right? Is something going to go down over there? That's my worry. The last thing I'll say is, when you think about there's a lot of research in this area. Does tight credit conditions cause recession, or does a recession lead to credit conditions? And at least the literature so far, it's the causality is reversed. That tight lending standards don't cause a recession, but if you have a recession which results in tighter lending standards, it prolongs the recession, right? So there's a lot here to think about, but I would say that you're right. We cannot take any comfort from the fact that this is over. All I was trying to do is to show that there's a fundamental difference at this stage between what's happening in 2022 versus 2008. But the fact that rates may have to go up, that ultimately some kind of recession is inevitable, that some sectors will be disproportionately impacted, will have a backflow onto the banking system and the stresses over there.
Yeah. So what is, of course, the US part, I'm not sure that, about, say, the very fact that you mentioned while you were telling us about how the US Fed has reacted, how it did in the last 3 years that led to this crisis where, the Dodd-Frank Act that you talked about, that, eased up regulatory conditions, the US government kind of made it easier for banks. So a lot of forbearance which happened ahead of this crisis, and now again you are, the US Fed and the government seem to be opening up its war chest for banks to survive. So what was the risk in letting those banks fail?
Yeah.
Why was it that the US government had to? I'm trying to understand whether, had it not been so, had the US government or the Treasury not intervened, created that kind of liquidity support for these banks, what would it have done? Do you think that it would have just blown over?
Really, that would have created a pretty significant stress in the system, because it was clear to depositors. So first and foremost, so let's step back here. The fact that so much QE was done meant you had that surge of deposits that I showed you. And
Yeah.
that meant that the percent of uninsured deposits in the system went up very sharply, right? So
Yeah.
the first thing, that part we all didn't realize at the time, that the quantum of deposits that are uninsured has risen sharply. Now, in that scenario, if you had let 3 mid-sized banks fail, then on that Monday morning, every depositor, right, in a mid-sized community bank would have run to the bank, withdrawn their money, and tried to put it in a systemically important bank that it knew the government would not let fail, right? And that would have led to kind of a bank run where a liquidity crisis becomes a full-blown solvency crisis.
Yeah.
Now, all community banks and all mid-sized banks went down, right? For things like commercial real estate, right, for business sector. So the consumer market, the mortgage market is very national in the US. But for business investment, you tend to rely on your local bank, on your regional bank. Think of all those regional banks went down.
Yeah.
What kind of Armageddon would have hit the economy? So by the time Silicon Valley Bank went down, it was too late. Regulators had already been taken hostage. And when you're taken hostage, you have to do, it's a second best response. The original sin, as I said, was how did we let ourselves come here? And we let ourselves come here through this perfect storm where regulatory policy was eased. You had to do a disruptive rate hike cycle. You overdid the response in COVID. It was a series of steps that got us over here. But yes, once you're in a situation where there's a deposit run on a pretty significant bank, and if you let that bank go under, it has a demonstration effect on every other mid-sized bank. It's too late. You have to step in and provide the regulatory support that they did.
Yeah. So say, for instance, now that, the crisis kind of knocked at the doors of First Republic, and then the banks got together and kind of showed a commitment of some $20 billion or deposits into the bank. So do you think that it is not stopping? Do you think that, there could be something more which is still?
Yeah. So you raise a very good point, and we'll get more data on this tomorrow. Actually, then the first week, despite the fact that there was this de facto deposit guarantee that policymakers had given, essentially no depositor was allowed to lose money in these 3 banks, and therefore the signal was nobody will lose any money, right? Without it being de jure, it was de facto. Now, despite that, you had a huge amount of withdrawals from these community banks that were put into systemically important banks. Now, when I say huge, it's hundreds of billions of dollars. It's still a small fraction of the total trillions of deposits in the banking system. But the data that we got was till March 15th. And apparently, Chairman Powell had said that in the second week and the week after that, that deposit withdrawal has stabilized. So the sense is that there was initial panic, and now with every passing day, that churn. So there will be, but let's make no mistake, there'll be huge distributional effects. You will have a case where deposits will leave certain banks and go to other banks, and that will have implications on credit impulse going forward. That you can't stop, but this is still better than what would have happened if all the community banks had gone down.
Right. So now coming back to the fears that you talked about, Sajjid, again, I'm trying to flesh out certain things that you said during your, presentation. 2 major fears whenever such a global crisis happens. One is, of course, the fear of caution. First is the fact that, it's a very, very uncertain environment. Uncertainty brings along with it a lot of fear. And one of the fears, of course, is that people will not consume. Demand will people will be very wary because they probably, I don't know whether they are, because of the worries that they have, the banking system, nobody's pulling out money. I'm not sure about what's happening in the US, but it definitely has an effect on consumption, such fears, and also about private companies' propensity or proclivity to invest. Do you think that one manifestation of the fear could be this, that lower consumption, lower investment by private sector?
So there's no doubt that as time goes on, lending standards are going to tighten, credit's going to become harder, and therefore that's going to slow the economy down. But it's important to understand what the backdrop is when the shock hits. It matters a lot whether US households are very dependent on credit, whether they're significantly leveraged, right? And then credit conditions tighten. Right now, in fact, I think consumption may actually still do quite well, because think of the backdrop here, that the labor market's red hot.
Yeah.
Wages are growing at 4.5 to 5%, right? Though still negative in real terms, and I still have excess savings.
Yeah.
So the fact is that consumers may actually not be so directly impacted by what's happening. I think businesses will be. There's no doubt that businesses will see credit conditions have tightened, and the uncertainty that you spoke about will mean that investment will likely slow. If investment slows, that will impact job creation. So I think that's the sequence, that what the Fed will hope to see is credit conditions tighten, investment slows, job creation slows, the labor market softens. When the labor market softens, then consumption will soften. So think of consumption being at the end of the pipe and the investment slowdown being at the beginning of the pipe. Now, what we don't know is the magnitude. It's very hard to calibrate this.
Yeah.
Will this be too little, so the Fed has to keep doing, or will this be too much and we get into a near-term recession?
Yeah. So obviously, this also follows that, given the fears that, the lending by banks itself banks may be more wary to lend now, which kind of makes it difficult for companies to borrow.
Absolutely. There's no question that lending standards.
It helps the Fed in its own way.
Exactly. The lending standards for sure are going to tighten, both because there is risk aversion, both because you'll have regulators breathing down banks, right? And because some banks are going to see that they've just lost deposits. Yeah. So when $10 of a deposit goes from bank A to bank B, it may well be that bank A's proclivity to lend was higher than bank B. So when the liability side moves, you will get changes on the asset side as well. So that's certainly going to happen. The question is this non-linear? Will it happen dramatically, or will it be, our sense is that it'll be a slow moving truck, that credit conditions will tighten slowly over time. And in so doing, do some of the Fed's work for it. And therefore, markets now think that, you may get one more rate hike, but Fed rates won't go to 6% because the risk-free rate is lower, but credit spreads are higher.
Yeah. So Sajjid, one last thing before I get into how it impacts India. So you think that Fed may not keep on increasing rates? Is your gut feel?
They're going to be very data dependent, Vaidhi. All of us have presumed for the last 6 months the data is going to slow. So if it turns out that this was a storm in a teacup, that the regulatory support was able to ring fence the stress, right? That yes, credit conditions tighten, but it takes a long time for that drag to build in the economy. Then we'll be back to chasing the macros.
Yeah.
And when you're chasing the macros, and in the next non-farm payroll sprint, which is due next week, we don't know what the number will be, but let's, for the sake of argument, say it's 200,000, 250,000, right? Or the next core inflation print month on month is still 0.4 or 0.5. That is just too sticky for the Fed to let go. So I think it's premature. I think the inclination of the Fed is, now that there is some financial market stress, we should do less. We should perhaps not make a type 1 error and overdo it. But ultimately, they'll be data dependent. If the data doesn't soften in the next 2-3 months, there'll be great pressure on the Fed to keep moving. They'll move slowly. So speed is out of the question, right? Until this crisis happened, what were markets penciling in? A 50 basis point hike in March.
Right.
So there's no question that central banks will now move slowly. But will the terminal rate, can we be sure the terminal rate doesn't go up more than markets think? We can't be sure, just given this resilience in the underlying economy.
Yeah. So, so what would be the downside to this? I was reading to some IMF research of 2013, which seemed to suggest that whenever there are such huge uncertainties in global financial markets, it can pull down growth by at least half a percentage point. Do you think that, we are looking at, as you pointed out, 3.5% for first quarter in the US, but globally growth, IMF pegs it at about 3%. You think that, it will be lower than 3% in the current year?
No question about that. I think that there's going to be elevated levels of uncertainty, high levels of risk aversion, and so growth is going to be slower. The question is that will slowing growth be disinflationary? That is the question, right? That will the global economy or the US economy have to go into a recession to bring inflation down? That's the question that nobody has a good handle about, and not knowing how to time the recession. Who's to say the recession may not happen in 2024?
Yeah.
Typical recessions, in two of the last 4 US recessions, the recessions happened 18 months after the Fed rate hike peaked. Now, Fed rates have not even peaked. In two of the four, it was 18 months. In two of the other four, it was years. So I don't know why we are presuming that the recession is going to come in July or December. We may be waiting till 2024. There's just so many known unknowns that we have to all have a large dose of humility. There are too many moving parts. Remember, one other thing we haven't spoken about, there are many fading drags from last year that are helping growth. Commodity prices are lower. Supply chains have normalized. China is growing at 7% in the first half of this year, right? So many of the shocks of last year have faded, and that's helping growth. And that's making the Fed's job even harder.
Yeah, absolutely. Now, coming back to India, one of the things we have always seen in India, whenever India grew remarkably, its exports have done very well, and that is linked closely to global growth. And I was looking at some chart recently, or 3-decade time series of how India's exports do very well, as and when the global growth it's doing fine. And in fact, exports are kind of rise much more than global growth rates as in these spans. So, do you think that is the biggest channel in which Indian growth gets affected?
So I think there are multiple channels. Of the 6 that I laid out, I think good news is that there is no direct exposure to any of these assets around the world. So that part we should be, thankful for. On the other channels, you're right that I think there are 2 parts. One is the macro stability, because we're in a situation now that the world may well be peppered with a number of shocks, repeated shocks. You mentioned just the shocks that happened the last 3 weeks. As interest rates keep going up around the world, you will get other asset classes in trouble. So I think the first thing we have to be prepared for is just that macroeconomic stability will command a large premium in most emerging markets. And the way it will manifest itself is you may have a sharp slowdown in capital inflows. The dollar may well strengthen, right? And so India will need to build buffers. And I think the RBI did a wonderful job of this at the start of the pandemic, right? Remember, people were bemoaning, well, why is the RBI buying so many dollars? Why don't they let the rupee strengthen? And some of us were very glad they did what they did. And perhaps the most important lesson from the last 2 years is buffers matter. So I think we'll have to continue to build buffers and keep high levels of FX reserves. I think the second kind of focus on macro stability is just keep our house in order. So the government stuck to its fiscal deficit target this year. It plans a meaningful fiscal consolidation next year. I think the current account deficit, which is good news, which was a large deficit 2 quarters ago, the current account may well be in surplus this quarter, helped by very strong service exports and lower commodity prices. So those concerns have receded. Perhaps the only lingering concern is core inflation. So headline inflation should come down. Core is sticky. We just need to solve on that front. So I think the first part of the policy response has to be that double down on macroeconomic stability. As the CEA rightly said, build margins of safety. I think those margins mean have higher reserves, bring inflation down, stay on your fiscal glide path. But the second part, Vaidya, as you rightly said, is a more chronic issue, which is that at some point this global economy is going to slow. Right? Economies we're in a strange situation where somebody says weirdonomics, not economics, but the global economy doesn't defy the laws of economics. At some point, you will get a slowdown and possibly a recession. and emerging markets in India will not be immune to that. It will have an impact on exports. And the implication is that the other drivers of demand, the capital expenditure that the central government has planned for next year in its budget, the capital expenditure of states, of PSUs, will have to pick up the slack if exports slow. One last point I'll make is there's so much focus on goods exports, but the real exciting story of 2022 is the surge in service exports. Right? IT services, software services, management consulting, R&D, technology. This net service number used to be 85 billion before the pandemic. This year it's tracking 150 billion.
Wow.
So because you've had more digitalization and more work from home, offshoring has become more attractive. So the good news is, at least on the services front, we have a hedge, but it remains to be seen how much goods and services exports get impacted by a global slowdown. So it'll have to be both focusing on macro stability and picking up the pieces of growth.
Yeah. So one of the things, like, when you, say in India, growth is always, there is a balancing act which the RBI does in terms of, whenever it looks at monetary policy of balancing growth and inflation. So what is the scenario that you see where inflation, of course, the RBI has been hiking rates, but it is focusing on an accommodative stance, with focus on accommodative stance, something which, exact phraseology, I'm not be correctly remembering it, but and there are very clear signs that growth will slow down in the coming year as far as India's potential growth rates are concerned. Do you think that there are fears of stagflation, where growth is not really much, but inflation is going to remain high?
No, I don't think that's a legitimate fear. Stagflation happens when you get a huge supply shock of the kind we saw last year. So when you have a big supply shock in the economy, oil prices jump to 120, that will simultaneously push up inflation and hurt growth. If anything, you should get the opposite situation now. As these supply shocks are normalizing, crude has come down, food has come down, for commodity importers like India, that actually provides a tailwind. Now, that said, Vedi, I think we need to be mindful of the fact that if the global economy slows and you get some kind of recession later this year, India will not be immune because we are very integrated. And that's fine. I think markets should not be panicking if there is a growth slowdown, because we will be seeing this around the world. If the US is in recession, Europe is close to recession, other emerging markets are slowing, some slowdown is inevitable. We should not panic or overreact to that. Think of that as the necessary adjustment that the world is undergoing. I think the key has to be to keep focusing on the fundamentals, so that when the global strife is over and the global economy is recovering, and the financial stress is behind us and interest rates are being eased, that India is in a good position, right? So the fact that balance sheets are strong in the corporate sector, the fact that banks are lending, the fact that service exports have picked up, we need to nurture those sectors and accept the fact that there is going to be some slowdown this year. That's inevitable. No country can escape that. What we shouldn't be doing is overreacting and trying to prevent what is naturally going to happen.
Yeah. So, one of the things which you talked about also is about, Indian domestic companies' ability to raise funds from overseas. Do you think that gets impacted because of this? Of course, global banks being more wary towards lending.
I think that will happen. I think global financial conditions, dollar funding markets have already tightened because of where dollar rates have gone. And I think risk aversion will rise. And I think what that means is you'll have more Indian companies refinancing domestically, right? And so, we said this last year as well, where some part of the credit growth pickup was because you had companies that used to borrow in dollars. The dollar borrowing costs have become too high relative to rupee borrowing costs, now borrowing in rupees. And so that should happen. And the good news is that the system can accommodate that for now. But this also means that capital flows could be lower if these dollar inflows aren't coming. But this is where the current account improvement makes a big difference. That the fact that the current account is lower means even if capital flows are less because risk aversion is high and dollar flows into emerging markets are lower, it will not hopefully create too much pressure on the balance of payments. I will say one thing though, we need to be realistic again on investment. The good news is that balance sheets are much cleaner. But remember, in manufacturing at least, utilization rates are still at 74, 75%. And we're living with unprecedented global uncertainty, right? I just laid out all the possible options. The Fed may have to move more, concerns about a recession, hard landing. In an environment like that, it's only natural that entrepreneurs in emerging markets will want to wait. So we should not be surprised that a broad-based capex cycle will take time, given the uncertainty around the world and given where utilization rates are, which is why it's really important that the public sector investment push should continue for another year.
Exactly. So you would say that, even if there is a marginal kind of slowdown in growth during the current year, it should not be very surprising.
It will not be surprising at all. I think everyone expects growth to slow. Everybody's forecast for FY24 is lower than FY23 to different degrees. There's so much uncertainty right now that putting out point forecasts, I think, in this environment is not very helpful. But yes, we should expect growth to slow. We should not panic as that happens, and we should just make sure that the fundamentals are in good place, so that when this global storm passes, growth can accelerate again.
Yeah, Sajjid, we were also talking about the natural hedges that India has. So, would you want to elaborate on that?
It's a great point. So I'm just going to pull up maybe the presentation again. So if you think about this, let me first start by showing you the one natural hedge, right? So we see that oil prices or commodity prices in general, but particularly oil prices, are inversely correlated with the dollar index, right? Now, as a large commodity importer, this gives India a natural hedge. What does that mean? When the dollar index rises and firms, it typically impedes capital flow to emerging markets. So in times when the dollar is strengthening, you will see the rupee is under some pressure and capital flows to India will slow. But because the dollar is inversely correlated with oil and we're an oil importer, at that very moment in time, our current account should be lower because oil prices are low, right? And therefore, you've seen that from 2010 to 20, you've had this natural hedge. Now, why was there pressure last year? It's because the hedge broke down, right? That you saw a situation where the US Fed was caught on the back foot. Markets priced in the fact that the Fed had to raise rates very aggressively and the dollar strengthened. And at the same time, you had the war breakout and oil prices surged. And because oil and dollar both moved up, it created a lot of pressure on the balance of payments. The current account widened and capital flows dried up. And this is where the fact that the RBI had plenty of ammunition really helped India. So that's one natural hedge. The second, of course, is that you have growth in commodity prices. So if exports slow because there's a demand shock in the world, right? So demand is slowing and India's exports slow, then typically commodity prices should soften. And as a large commodity importer, you get it terms of trade benefit. So you're worse off on exports, but you're getting some offset, partial offset on terms of trade. Now, this is only when there's a demand shock. If there's a supply shock, right, then it's the opposite, because then commodity prices rise and global growth slows. There's a third hedge. The third hedge is if you look at capital inflows and domestic financial conditions. Now, think of what happened last month. There was risk off in the world because of what happened in the US. And risk-free rates in the US actually fell 50 basis points. The 10-year yield went from 4% to 350. Now, this was actually a tightening of financial conditions in the US because US credit spreads went up. But because the risk-free rate had come down, risk-free rates in many parts of the world, including India, came down when the US 10-year went down. And because our credit spreads didn't go up, there was no problem in our system, financial conditions actually eased. So even as global financial conditions tighten and capital flows are impinged, if risk-free rates are going down and you have lower bond yields in India, that gives you at least domestically some relief in terms of financial conditions. So, this is why I love economics, right? If you think of general equilibrium, there are all these offsets, and there are several natural hedges, whichever way you cut them: growth and commodity prices, the dollar and oil, global financial conditions, and domestic financial conditions.
Yeah. Before I, switch to, requesting the audience for questions, one last question, Sajid, is what would be your policy prescriptions going forward for India?
I think more of the same. I think the first is to put a real premium on macroeconomic stability. No emerging market should get complacent, even though, as I mentioned, this may well be a liquidity crisis, because we're in this time of great uncertainty, right? People call it the poly crisis. And so the economy is being peppered by shocks. And I think so the first thing has to be double down or continue with macro stability. That means keep inflation well under control. It means continue on our fiscal consolidation path. It means build all kinds of buffers and keep a very close eye on financial stability, as the central bank is doing. I think the second piece of advice is, if there is some slowdown, as I've mentioned, let's not panic. Let's do what we can, which is let the public, and if there is a slowdown and if there is high uncertainty around the world, it stands to reason that the private sector in India, if entrepreneurs are worried about what's happening globally, they will react accordingly. So the private sector may well temporarily retrench, which means the public sector, which has been pushing hard on capex, needs to continue doing that work for another year till the storm passes.
Yeah. Thank you. From our friends who are in the audience, may I request Mr. Bisma Chaudhary, a senior counselor at Plutus IAS. Yeah, Bisma, please go ahead. I think you're on mute.
So, yeah, sir, my question is, so one of the factors that protected India from the immediate impact of the global financial crisis was the public ownership of banks. How do you think this privatization of banks will deal with any financial crisis today or tomorrow?
I think what matters more than ownership is regulation, right? And so we've seen that, yes, public sector banks didn't have any exposure, but neither did private sector banks. So I'm more agnostic about ownership. I think we need to focus on efficiency in the banking system. And Indian regulators have had a very strong and long track record in making sure that regulation is prudent, and all encompassing. So I want to just say that we should not draw the wrong conclusions here. I think the right conclusion is we need to focus on a banking system that's efficient, and as the economy picks up and the investment cycle picks up, that's able to service the needs of the broader economy.
And Sajid would also say that the Indian banking sector is kind of resilient, able to take any shocks, although there seem to be none right now, at least from the external sector.
Yes, because I think we paid our dues. Remember, for many years, there was an issue about bank risk aversion. And the fact is, over the last 3-4 years, that hard work has been done. Banks have been recapitalized. The NPAs have been resolved. Thankfully, the NPAs in the pandemic were much less than there was feared. So banks are, after a long time, in very good shape. And you can see that in their lending behavior.
Yeah.
And the fact that regulation has always been prudent in India, I think, gives everyone much more comfort.
Yeah. May I request Ishita Bhatnagar, who is a research scholar with IIT Delhi? Ishita, if you can unmute yourself and ask.
Hello.
Yeah.
You would expect a lot of noise from my side because I'm traveling, but yes, it was a very nice presentation indeed. And I am not from the economy background, so my question was actually very generic. When I saw the topic first, so I've been hearing a lot of my friends being laid off from the US and all the companies. So my question was very, very generic. In fact, I don't know whether that'll be very relevant also or not, but then still, um, how do you see that this opportunity, rather this adversity, for the time being adversity, could be taken as an opportunity for India, where we can look for in India campaign itself?
Well, I missed the last 30 seconds, but here's what I will say, that you're right, that you're seeing that in certain sectors in the US, there is stress. In the tech sector, there have been some layoffs because the tech sector had frankly overextended itself over the last 2, 3 years. Now, as the tech sector slows in India, slows in the US, there are two implications for Indian software exports and IT companies. One is that as discretionary spend on IT slows, maybe that hurts software exports. But there's another offset to that, that as cost pressures become more acute, the incentive to move people offshore to India could actually increase. See, what's changed is in the pandemic, the mindset has changed. If you have a firm sitting in New York with employees in Ohio work from home, then there's no reason why those employees can't move to Bangalore or Hyderabad or Pune, right? And so, and the number that I quoted, that 85 billion has gone to 150 billion, is the reflection of that structural change. That there's been a re-embracing of offshoring. I'll make one final point, Vedi, because this is really important. There's been a lot of head scratching about the fact that goods trade is slowing around the world. You're getting more economic balkanization. But the next 10 years may well be the time where you get huge services trade and trade in services, right? And India clearly has shown to have a comparative advantage in this. Now, as the global population ages over the next decade, India actually has a very young population. And technology enables India to sit here and still be a service provider to the world. So this is, in principle, a huge opportunity. Now, of course, there's a caveat. These are typically white-collar jobs for skilled workers. We still have to solve the problem for blue-collar jobs and unskilled workers. But this is a huge change in the pandemic that affords India a big opportunity with a big runway.
Yep. May I request Mr. Nagendra Shastri of ProClink to ask his question? Yes, Mr. Shastri.
Hi, am I audible?
Yeah, sure.
Okay, great. So thank you so much. It was indeed a very insightful discussion. Thanks to Dr. Chinoy and Vaidi. Basically, my question is about the kind of delinquencies that we've been seeing on the loans and cards, especially in the US. So the effects of COVID freebies is certainly going away, and the stress is being seen on the consumer side, especially because of the reduced disposable income and all that, because of the inflationary pressure and all that. So I think it looks as if I work for banks. All those, a couple of banks that you really presented, like M&T Bank and the PNC and US Bank and all that, were at some point of time my clients. But basically, point is that I think there is increased discussion that the recession is not too far away and it is really nearby kind of thing, and the Fed is not stopping; it is increasing the interest rates. So that's where I was a little confused. That are we? Is the general consensus the recession is going to be in this? I also saw the graph where you said that there is 20% probability that JP Morgan thinks and all that. But how is the general consensus, right?
And I think there's so much uncertainty that there is no general consensus. But you're exactly right. Nobody can bang the table and say the recession is not going to happen next quarter or 2 quarters from now, precisely for the reasons you mentioned. There are many forces in motion. One force is that credit conditions are tightening. Another force is interest rates keep moving up. But the simple point I was trying to make is, at least from a macro perspective, we're not seeing any cracks in the private sector just as yet. Now, that could change in 2 months' time, right? So will there be sectors of stress? Will there be certain cities or states or micro markets? Yes. But if US consumption is growing at 4.3% this year, and 800,000 jobs been created over the last 2 months, and consumer confidence actually picked up in the month of March, at least it says that the consumer for now, is humming along.
May I request Raj Nair from Avalon Consulting to ask his question. Hi, Raj.
Muting myself.
Yeah.
Hi. Sajjid, your talk was very lucid. Thank you. And even the discussion between you and Vaidyanathan was very insightful. My question is very simple, but it's loaded. Do you expect the next financial year, starting day after tomorrow, to deliver about 5.5% real GDP for India? And there's a reason, there's a context. You said that right now, the corporate balance sheets, the bank balance sheets globally are very strong. It was strong in 2007 at this time of the year. Even the capital markets were gung-ho at that time. But there was that little kida or animal called CDS, which was bothering me. And as I collected more data in September, I started writing articles and giving talks on how there's going to be a huge crisis in 2008. Now, let me cut back. Let's assume that to some extent, this problem today has been capped, the SVB Bank and other things. To some extent, no one can predict what more can happen because there's $1 trillion of unrecognized losses, but there's no panic among depositors. That's a good thing. But on December 10th, 2022, just 4 months ago, the Bank for International Settlements discovered that the global commercial banks have hidden $80 billion of debt, hidden debt, under the guise of Forex derivatives. It was discovered by them accidentally, and now they've told all the central banks, look, you guys have not realized that there's a crisis. Now, do you think all this together can create a problem whereby the liquidity can only tighten further, and therefore the corporate balance sheets, although they were good, the banks will spend less, and for our non-traditional exports, the BFSI sector is extremely important. More than half the revenue of the IT sector, which you talked about, comes from the BFSI sector. Now, if they clamp down, our exports of IT, etc., our exports of traditional exports are anyway down last year. So we have a little challenge on the export front. On the domestic front, we've got El Nino playing out, and we don't know what's going to happen to the agriculture. It's not great. Okay, the situation as it stands. So will the rest of the economy absorb these shocks and deliver 5.5%? My estimate is lower than the government's estimate, of course. But that's the question. I'm sorry I gave you a long background.
That was a terrific intervention. Thank you for that. I think to your point about what's happening globally, as I said, we have to be very humble that just given the complex web of financial transactions that occur with all the liquidity that's been injected into the system, we can never say never. We don't know where the next, there was one bullet point in the chart which says, speed matters. When you raise rates by 500 basis points, for a year I've been saying something somewhere is going to break. So far, 3 things have broken, but they haven't been systemic in nature. But we don't know whether the next break will be more systemic. So completely accept those concerns and risks. Now, when it comes to India, I'm not trying to cop out here, but I just I don't have the confidence to give a point estimate on growth, just given the range of uncertainty. If the US goes into a meaningful recession in the 4th quarter of this year, right, which is the 3rd quarter of our fiscal year, that clearly will have an impact on Indian growth. If it turns out the global economy is far more resilient this year, but we're heading towards a hard landing next year, then this year's growth could be higher, but we'll have to mark down next year's growth. If we get El Nino, but it's in August, September, it could affect the Kharif crop, not the Rabi crop. If the US and Europe slows, we don't know to what extent they affect service exports, because this is an untested animal. So my point is that there's so much uncertainty that it's very hard, I think, to give a range and be confident. And therefore, I'm less fussed about what the number is. Even if we do get growth that's less than what markets estimate, that's okay. As long as we go back to first principles and ensure that there are no imbalances developing in the economy, right? That balance sheets remain clean, bank balance sheets remain clean, we hit our public capex targets, inflation is down, macro uncertainty is down, so we can pick up the baton and this is done. So I hear you. And that's why I think even the chief economic advisor gave a big range of estimates in his economic survey, because we're living with unprecedented uncertainty.
Yeah. There are a couple of more questions, Sajid. I hope with your permission, can I take them?
Yeah, absolutely.
We have one from Mr. Kumaraswamy Virupakshan, who's a research scholar with MDI. If you can please unmute yourself.
Have I unmuted?
Yeah, sure.
And Dr. Chinoy, as usual, a very great presentation, very lucid and very free-flowing and packed with a lot of information. Thank you so much. And thank you also for acknowledging the RBI's very effective role, which is not generally appreciated. A misstep here and there gets highlighted, but when they get so many things right, despite the things going wrong, nobody appreciates them. Thanks for that too. Two questions. One is, did Fed miss up in reacting very fast, overnight swap or buy-sell swap or quick infusion of liquidity through a repo kind of structure would have perhaps even prevented this SVB is my thought. If in a situation where liquidity alone is a problem, not the solvency or the valuation, Fed has all the powers as well as the responsibilities to prevent that collapse. I think Fed has failed, in my opinion. It may be a matter of minutes, or hours if they had acted fast. Maybe they could have prevented it. That's number one. Number two, is the current episode also exposing the excessive reliance on interest rate alone as a monetary policy tool? If you keep on increasing the interest rate at the long end, obviously many of them are going to suffer huge valuation losses, and many of the banks, given the current mark-to-market losses being marked in the balance sheet, will be in trouble, and that will create a banking crisis. You would have solved maybe inflation, but there will be a banking crisis. I just wanted your reactions.
Again, both very good questions, not easy to answer. I just say that given how easy it is now to move funds from one bank to another, think of what happened on that Thursday afternoon. $42 billion of deposits left Silicon Valley Bank in one afternoon, right? Very homogeneous kind of depositor base, wholesale, high value, venture capital people. Once word spread, everybody took their money out. So one can always second guess whether the Fed could have moved 24 hours earlier, but I come back to the fundamentals that I think the original sin in my mind was to load the system with QE. I've always been wary about just how liberally central banks have been expanding their balance sheets in the belief that magically there'll never be any inflation no matter what the size of the balance sheet is. And it was the combination of the four things that I said that I think set us up over here. That first you had this huge stimulus withdrawn very slowly. We had a full year of inflation, and this is all counterfactual. So, admittedly, but if the Fed had started raising rates in 2021, maybe we wouldn't have to be in a situation where you're raising rates 75 basis points meeting after meeting. That this could have been a far more calibrated increase, and we wouldn't have hit the speed breaker so far. So, I think it's wise after the event. But for me, those were the pressure points. That the combination of this large stimulus, and we saw this, even in India 10, 11 years ago, where after the global financial crisis, there was a large stimulus and it took us a time to come back, and that led to some imbalances in 2011, 12. But I think once you had a situation where banks had such high levels of uninsured deposits and interest rates had to go up, the genie had left the bottle. It was a matter of time. On your second question about interest rates, this comes back to the age-old question of, does monetary policy matter? Again, here we have to be humble that monetary policy is a blunt instrument. It has long and variable lags. And so the key is, again, to go back to Tinbergen, that if there are multiple objectives that a central bank has, right? It's inflation, it's financial stability, it may be something else, that you have to identify multiple instruments and allocate that. I still think you could have continued raising interest rates to bring inflation down if there was no regulatory easing. Think of what would have happened if that Dodd-Frank Act was not eased, and you had pretty rigorous stress tests on banks like Silicon Valley to identify the problem and ensure that they never reach such a situation. So I think it was not that interest rates were the culprit, it was that we were not using the right tools to address the right objectives.
Great. Thank you, Sajid. May I request Mr. Chitranjan Chattopadhyay from ICAI, Institute of Chartered Accountants, Cost Accountants of India. Sorry.
Thank you. Thank you. Thank you. It's a magnificent interactions going on between Dr. Sajjid and Vaidyanathan Iyer. I have got two questions, simple questions. That G20, whenever the G20 summit was there in Bangalore, we have found that global economy, sustainable finance, global health, financial sector, financial inclusion, infrastructure, international taxation, international financial architecture, etc., were discussed at length. And there, India has become one of the country under the presidency of our honorable Prime Minister. The Financial Stability Report (FSR) is now going to be very much implemented by the Reserve Bank of India for this, this expected credit loss mechanism has been, framed out. But the discussion paper has been floated by Reserve Bank of India, where the Basel, whatever the IRAC norms were there for the, risk mitigations and the NPA, whatever we have seen, that is now going to migrate to the expected credit loss mechanism. So I just want to mention you here, this expected credit loss mechanism of the banks. Do you feel that this particular, it would be in the Indian banking context, where the Indian banking starts from the masses to the class banking, mass banking, class banking, all are going on. How this expected credit loss will be ultimately be implemented in the context of this particular, this global financial stability report. And second is that no banks we have found, they are very much cost, there is no cost compliance. Cost compliance is one of the very important resource. Optimization is very important. So far, my knowledge goes, I would ask Mr. Sajjid also, whether this cost competitive, the cost optimizations, resource optimizations, any specific department has been established in worldwide or in India, it is not established. Because this is a growing concern for survivability of the both public sector banks and private sector banks. Thank you, sir.
These are very good, detailed micro questions. To be fair, I have not studied what the expected credit loss mechanism entails. So let me just say, let me study that, understand what the implications are for Indian banks, and very happy to take this offline. I'll get your details from Vaidi, and we can have a bilateral conversation once I understand that process a bit better.
Yeah. There's another question from Mr. Partha Mukhopadhyay. If Mr. Mukhopadhyay is in. Yes, Partha. If you can unmute yourself.
Thanks, Vaidyanathan. Thanks, Sajjid. Sajjid, one of the issues that you seem to indicate in your remarks is that in India, private investment is holding back because of polycrisis and other sort of general uncertainty, and that public investment should therefore continue to fill the gap as long as this situation sort of continues. But if you look at private investment, especially in sort of bricks and mortar, that's been sort of shy for over a decade now. So is this cyclical or is this structural? And on the public side, what kind of investment do you think they should be doing? Right now, what we see is largely big ticket kind of projects. But should that move to more sort of maintenance, high employment kind of structure? So is the mix of public investment right? And is the private investment story more cyclical or structural?
Partha, thank you very much for a great series of questions. So just to break down investment further, if you break it down, there are three categories, right? There is large corporates, there is household and SMEs that Partha was alluding to, and there's public investment. Now, public investment for the most part has been flat, and I'm going to come back to it in a second. And Partha makes a very good point that if you look at the history over the last 10 years, the investment to GDP ratio has fallen largely because household and SME investment has come down quite meaningfully. Corporates have softened in the last 10 years, but that has been a smaller decline. So let's take each of these in turn. The worry was that the corporate investment headwinds were more structural because of the twin balance sheet problem. And Partha, I'm hopeful that with those twin balance sheet issues now resolved, corporate debt is now the lowest since 2006, banks are less risk averse, that this now hopefully will go from structural to cyclical in the sense that utilization rates for manufacturing are still at 75, 76%. So again, this is a hope that, 12, 18 months from now, when hopefully utilization rates are upwards of 80 and some of the global uncertainties have resolved and animal spirits are back, that the combination of those two things will mean you get some pickup in corporate investment. Now, you're exactly right about households and SMEs. What I will say is there's a little bit of, there's some optimism on residential real estate. We had a decade of malaise, and at least the last 12 months, you're seeing residential real estate pick up. Affordability has gone up. But again, I need to caveat that it also happened because monetary conditions were very accommodative in the pandemic. And it remains to be seen to what extent residential real estate is impacted by the monetary normalization of the last 12, 15 months. The black box really is SMEs. And I think this is what you were alluding to, that we would need SME investment to pick up. Now, what's holding that back? Is it more structural? Is it more cyclical? That is a genuine open question. So I guess my comments were more directed to just corporate investment, which I know is only one piece of the puzzle, that at least with the twin balance sheet problem resolved, hopefully now we're moving more to cyclical terrain, but fully acknowledging that SMEs are the black box that we need to understand better about what will it take for SME investment, which is job creating, labor intensive, to actually pick up again. On public investment, Partha, I think there are two issues. One, you raised very well, what kind of projects do we need to do? I would just say that that's a good to have, but first order, CapEx has a large multipliers. Infrastructure creation, construction creates blue collar jobs, the blue collar jobs that were impacted by the pandemic. So I'm just taking heart from that at least if we get public CapEx, we're getting some of those benefits. Now, you raise an important point. Central CapEx has picked up a lot, but you've seen PSU CapEx actually soften in tandem, and state CapEx has been very flat. So if you add it all up, then the entire public sector CapEx is more flat. Now, the question is, why is state CapEx, for example, so flat? Money was not the problem. The fiscal deficit of the states went from 4.1 to 2.8 last year when they didn't need to go. This year, only about 65% of the interest-free loan from the center has been absorbed. So I think there's a broader absorptive capacity issue here that we need to address when it comes to CapEx. So your question is an important one. What should we be doing to make sure that public investment is labor intensive and creates jobs? And I would ask, what should we be doing to increase absorptive capacity across states and PSUs so that they complement, not offset what we're seeing at the center? Sorry for the long response.
No, absolutely. Sajjid, what this is something which missed my attention also about, on the SME front, if I may just ask one more question, referring to literature, which I kind of came across over the last couple of weeks on, pricing power of, big corporates, how it has, gone up, and largely many attributed to the absence or lesser SMEs in the market today. What does your anecdotal and when you talk to people in the industry, what does it suggest to you? Because from what we gather, there is huge stress, and since there are very huge formalization which has happened over the last few years, for multiple reasons, as not many SMEs have also been out of business or have temporarily shut down or facing liquidity and other issues to continue to do business.
I guess the broader question, Vedi, is a very good one, is why has core inflation been so sticky in India at a time where we're still below our pre-pandemic path, and with utilization rates where they are, there's clearly some slack, both in terms of capital, and there's slack in terms of labor. So why has core inflation been so sticky? It's one of those great puzzles. Two hypotheses, and frankly, these need to be proved. So they're just hypotheses for now. One is that if core inflation is sticky in the existence of slack, economist jargon is the Phillips curve has moved up. Again, this is just a hypothesis. That could happen for two reasons. One is that inflation expectations have hardened. And you're seeing some of that in the surveys, both the IIM Ahmedabad survey for businesses and the RBI surveys. Or the second is, as you alluded to, that around the world, we've seen that COVID was very Darwinian. Large firms increased their market share. Do they have more pricing power? Has the industrial structure changed? It's a hypothesis. We don't know. I think this year will be very revealing. If growth were to slow and core inflation comes down, then concerns about a Phillips curve moving up would be far more allayed. But if growth slows and core inflation still remains very sticky, then this is work for a lot of PhD students, if there are any on this call, to ask this question: has India's Phillips curve moved up, and if so, why?
Yeah. On that note, thank you so much, Sajjid, for such a brilliant presentation as well as lucid explanation of things. We will continue with our Explained Live, one of the most watched episodes that we or the programs that we have organized in the Indian Express. Let me profusely thank our partner in this initiative, Plutus IAS. Thank you, Sajjid, and thank you all the audience members for being with us. Thank you once more.
Thank you, Veli. A pleasure.
Thanks.
Good to be on. Bye.
Plutus IAS. Our features are live interactive classes, limited batch size, well-qualified and experienced faculties, doubt removal sessions, current affair classes, study material and test series, mentorship program, mock interviews. To know more, contact us at 844-844-0231 or visit our website www.plutusis.com. Plutus IAS. Our features are live interactive classes.